everyone. One thing that truly fascinates me about technology is how it completely changes our daily lifestyle. I mean, think about it. Just 10 years ago, who would have thought that today we would be ordering food at our doorsteps or investing our money with just a few clicks? Or buying clothes and fashion accessories online, or buying an insurance policy online, or taking a loan online, or booking hotels and flights online. And the latest trend of buying groceries online, that too within 10 minutes. Today, platforms like Zomato, Blinkit, Swiggy, Instamart, Paytm, Nykaa, Policybazaar, Grow, they all have become household names. They are not just startups anymore. They are powerful internet companies shaping India's consumer economy. And these companies have already been listed in the Indian stock market in the last 3-4 years. Recently, listings include your IPO of Grow and Urban Company. Going forward, many more new age companies are expected to hit the secondary market. So there will be many opportunities for retail investors to be a part of new age platform companies that are disrupting consumer behavior. The only question is, at what price should you buy them? Because if you entered during 2021 IPO hype, you probably lost money. But if you entered when the noise faded and the profits start showing up, you might be sitting on massive returns today. So in this video, we will discuss the rise, fall and comeback of India's new age companies. And more importantly, how to identify the right time to invest in them. Alright, let's get started. Between 2020 and 22, India witnessed the listing of new age businesses, startups going public for the first time. The first new age company that went public was Zomato, now known as Eternal. Its listing was on July 21, and I clearly remember it was one of the most hyped IPO of that time. Also, we were at the peak of the bull run post-COVID, and of course, Zomato by that time became a hugely popular food delivery platform. So every person was able to relate with it. Company launched its IPO at around 76 rupee with a market cap of around 60,000 crore. And guess what? Zomato got listed at 66% premium at 125 rupee, taking its market cap to more than 1 lakh crore. Just to give an idea, during that time in 2021, its revenue was around 2,000 crore and company was in consistent losses. Zomato Mania did not stop there. It went on to touch highs of more than 160 in no time. But then we witnessed a massive correction. Just hold on to this for now. We'll discuss this correction in part 2. Then another popular IPO was of Nykaa. Its IPO price was around 1100, but it got listed at 78% premium. Another example is PB Fintech, parent company of Policybazaar and Bank Bazaar. It quickly jumped 50% within a few days of its IPO price of around 980. Then Paytm got listed at around 1.3 lakh crore market cap. It was India's largest IPO at that time. During that time, the common narrative was, these are the next Amazon, Uber or Shopify of India. But the problem was, their valuations were built on growth narratives, not earning. And then came the realization phase. Let's have a look. So the hype that was built for new age companies did not last very long. Soon reality caught up and new age companies started crashing. Suddenly sentiments turned deeply negative over social media for these new age companies. And this was not a small correction. This was a full-blown reset. Zomato share price crashed 76% from 160 rupee to 40. People started comparing it with Tomato. Then Nykaa also corrected more than 70%. Paytm share price crashed nearly 80%. Mind you, they were not microcap companies, they were large cap companies, but their correction in stock price behaved like microcap. Then I remember another company, Car Trade, that tanked around 75% from its IPO price. PB Fintech crashed another 75%. By the way, I am using Scanx platform for my analysis. That is also our partner in today's video. I use Scanx to analyze the share price movement, key fundamental data points, peer comparison, financials, shareholding, corporate action and various other important updates. It's a great stock market screener where you can analyze all listed companies along with access to important news, various insights like heat map, mutual fund latest buy-sell decision and many more data points. You can also access various screeners like Capex Boost, Mighty Midcap Stocks, Steeler Small Cap and so on. In fact, you can even create your own screener. So let's say you want to create a screener for top quartile results. Then just add year-on-year last quarterly sales growth and year-on-year last quarterly profit growth. Now you can just select the index and sort the list by highest to lowest profit growth. Here, metal companies have reported Steeler number, followed with Bharti Airtel, Ultratech Cement and so on. Likewise, you can do this for mid cap, small cap and so on. You can also put other filters like industry, market cap and so on. And this is all free to use. Likewise, you can create multiple screeners. If you want to explore Scanx platform, you can check the link in the pinned comment. Now, what was the reason for brutal correction in new age companies? So the biggest reason was end of market euphoria. During 2021, when most of these new age companies got listed, we were at the peak of market euphoria post-COVID. Everyone was chasing hype. Also the fact that post-COVID bull run attracted millions of new traders and investors who did not know much about fundamentals and valuation. And today we live in the world of social media where both emotions of fear and greed gets multiplied. So during that time, every investor felt FOMO, that is fear of missing out on these new age companies. So there was literally a race to buy these new age companies at any price. But once the IPO euphoria faded, the market started asking tough questions. Where are the profits? When will cash flow turn positive? Are these valuations justified? Is growth coming from real demand or just from massive discount and promotions? At the same time, global interest rates begin to rise sharply. And when interest rates rise, the first segment the market punish is high growth loss-making tech companies. Slowly the hype turned into hesitation turned into doubt, and doubt turned into panic selling. And that resulted in massive correction in new age companies. But this phase, the painful fall, is actually the most important part of the story, because this is where a company either proves its business model or gets exposed as a hype story. That takes us to the third part of this video, that is the comeback. The third phase of new age companies was very interesting. On one side, more and more people were using their products and services. On another side, they were hating their stock price. In the meanwhile, these new age companies also realized the fact that it is high time to stop burning cash for growth. It's time to focus on profits. Also, there were some big pivots. For instance, Zomato, that was mainly into food delivery business, acquired then struggling quick commerce company Blinkit. While Zomato food delivery segment was restricted to metro cities, Blinkit disrupted the grocery retail industry of India with its 10-minute delivery model, and it completely changed Zomato's future. Blinkit became the key growth engine for the company as it's expanded from metro to tier 2 and 3 cities of India, and was clearly visible in revenue growth. From 2,000 crore top line in 21, Zomato revenue jumped 16 times in less than 5 years to now at 32,000 crore mark. And from losses, it turned both EBITDA and PAT positive. As a result, Zomato share price has jumped nearly 7 to 8 times from the lows of Rs 40. Similarly, PB Fintech stopped burning cash on customer acquisition, focused on renewal of premium, and scaled its credit vertical. As a result, its revenue jumped around 6 times and it also became profitable. So its share price jumped nearly 6 times from the lows. Car Trade made a big move by acquiring OLX India's auto business. Suddenly, it became a dominant player in the used car digital ecosystem. Its revenue jumped around 3 times, but look at the sharp jump in margin. This resulted in a 6 times jump in operating profit, and its stock prices jumped 8 times from the lows. Nykaa revenue has jumped 3 times and operating profits are up 3.5 times. Its stock prices jumped more than 2 times from the lows. Then another company, RateGain, reported massive growth in revenue and profit that resulted in exponential growth in share price from the lows. Even Paytm has jumped 3.5 times from the lows. Recently, more new age companies like Urban Company, Lenskart, Grow, they all have been listed in the market. And out of these 3, Grow share price is already up around 50% within few days of its listing. So one thing that has been established that these new age companies that tanked badly from the highs post-listing have rebounded sharply. But the big question here is, how do you identify the right price to buy them? That takes us to the fourth part of this video. To identify the right entry point, you need to look at 3 important factors. First is you need to look at the business model proof. See, new age companies will burn cash in the early years. It's normal. But what you must track is whether revenue growth is becoming predictable, is contribution margin turning positive, is EBITDA loss shrinking consistently, is unit economics improving. If the business model is maturing, the risk starts reducing. This is where Zomato, PB Fintech and RateGain turned around. Even Nykaa has done reasonably well, and now Paytm is also showing all positive signs. Then you need to look at the valuation reset. Now this is very critical. First of all, the catch is you can't look at traditional metrics like PE ratio for these new age companies. That's where you can look at price to sale metric. For instance, during peak, Zomato price to sale was at more than 50 level. And when the euphoria faded, it fell down to below 10 price to sale. Nykaa, same story. Price to sale above 40 during peak, that fell to below price to sale of 10. Paytm, that was listed at price to sale of 10 times, that touched the bottom of price to sale of 2.5, although that was a unique situation. Card trade price to sale fell from more than 25 level to levels of 5. PB Fintech fell from price to sale of more than 60 to levels of below 10. By the way, for a traditional business, even a price to sale of 10 is high, but platform companies would command a premium valuation. That said, if a platform company has a price to sale of below 10 and business is promising with fast growing top line and expanding profitability metric with a bigger TAM, it is worth considering. Recently, Urban Company got listed at a price to sale of more than 20. Grow similarly has a price to sale of about 20. Obviously, the IPO listing always happens when the market situation is good or the company has witnessed massive growth in last 2-3 years. But you will get a good valuation multiple only when the industry or the market is going through a tough time or the company is going through tough time. Here you got to understand that every company will go through cycle. It's just a matter of time. The key is how much patience you have to wait for the right entry point. Then third factor you should look at is look for institutional confidence. During the down cycle, when the valuation becomes much reasonable, you should keep a close eye on institutional buying. For example, even when Zomato share price climbed to levels of around 40, DIs were consistent buyer in the company. Similarly, look at institutional buying in Nykaa. Public holding kept on falling. PB Fintech, same story. Public holding falling, DI kept on buying. So when FIs, DIs and large funds start accumulating, it usually signals that numbers are stabilizing, worst is over, and market believes the business is heading towards profitability. So what can we learn from the rise, fall and comeback of India's new age companies? One thing is for sure, these businesses are here to stay. They are shaping India's consumption revolution. But the mistake most investors make is they buy the story, not the price. The truth is, even the best businesses becomes a bad investment if you buy it at the wrong valuation. And even an average business can create strong return if you enter at the right price. With new age companies, the right time to invest is not during hype, not during IPO Mania, but when three things happen together. The business model starts proving itself, valuation compressed to decent level, and institutional investors quietly start accumulating. Friends, India's digital economy is just getting started. More internet companies will get listed in the coming years, and the opportunity will be massive. Your job is not to chase hype. Your job is to wait for the right moment and invest when the narrative shifts from dreams to data. If you can master that, you will always find yourself on the right side of the next big wealth creation wave. I know it's not easy, so if you still want to ride the new age companies of India but not sure about what to buy and when to buy, maybe you can consider Nifty India Internet Index. There are a couple of ETFs that replicate this index. First is Grow Nifty India Internet ETFs. Second is Mira Asset Nifty India Internet ETFs. Again, the journey would be very volatile. So the best approach is to invest in a systematic manner, and you need to have a long-term investment horizon. Now tell me in the comment, which is your favorite new age company? If you find this video useful, do share it within your circle. I'll see you in the next video. Till then, take care.